Hey, how's it going, everyone? Zachary Jensen, managing partner at TaxWise Financial Services here, where we're empowering small business owners with tax savings so they can grow with confidence. Today, I wanted to go over a very, very powerful topic around passive versus active investing. If you are investing in businesses, then this video is for you. You definitely need to watch this because we're going to go over the differences between active investing and passive investing and how your taxes are going to be heavily, heavily, heavily impacted. If you do passive investments, now you're going to get a lot of tax savings. Active investments, obviously, you're going to get active income and you might get active losses, which can offset your other active income, which is a plus. But we want to have income usually as passive as possible. So this video is going to go over a few different strategies, passive versus active. And if you're investing in a business, how do we work with Section 469 to avoid any sort of material or participation? So we're going to go over all of that in this video today. So, for those that invest in businesses but do not actively participate in their day to day operations, you need to understand the passive activity loss rules and how they leverage passive losses to effectively make huge financial differences in your taxes. The best tax deduction for passive investors often involves strategic use of the passive activity loss rules and passive income. And this is where limited partnerships and carefully structured investments can become powerful tools. So, let's go over Section 469 in the passive activity loss rules. Number one, active income, right? So you've got earned wages, salaries, self-employment, or business income, which the taxpayer materially participates in. Note on materially participates. If you are involved in the business in any way, helping them out in any way, well, that can be considered material participation for you. Number two is portfolio income, right? So you've got interest from dividends, interest, capital gains, and then you've got passive income, right? Income from rental activities or businesses in which the taxpayer does not materially participate. So again, hence on material participation, except you're not doing it in this case under the passive income part. So what's the difference between material participation and passive participation? So the IRS has established 7 material participation tests to determine whether a taxpayer is actively involved in a business. And if a taxpayer does not meet any of these tests, their income from that business is classified as passive. So the most common tests for material participation include more than 500 hours worked in the business during the year, more than 100 hours worked where no one else works more than the taxpayer, significant participation activity where you do 400 hour or 500 hours across multiple businesses. And if you don't meet any of these tests, then the income could be passive, and you could be considered a limited partner, which is a key to passive income classification. So an LP or limited partner is one of the best vehicles for a passive investor to structure their investments. You're only limited as far as your liability to what you put in, so you can't lose any more money than what you put in. And the IRS automatically assumes that limited partners are passive investors since they have no active role in the business. So this means that all income from the limited partnership is passive and all losses from the limited partnership are passive. Now, this takes us into some really interesting strategy stuff we can do. You can imagine if I am a business investor and I participate in my current business and I have a lot of gains. Well, I can find another business and participate in that, and maybe that business has a lot of losses and it offsets my gains. Or I'm thinking of buying into a business, and let's say they make pretty good cash flow. I'm going to make some pretty good returns. Well, we want to find a way to categorize that as passive as much as possible. So even if you're getting involved in it, as long as you do not pass any material participation test, then you will be classified as passive. And that's super important for investors to understand because they automatically think just because they're giving an hour a week or an hour a month of their time to some consulting or a board that they're automatically active income, and that is not the case. Of course, in some cases, and that could be costing them tens of thousands of dollars on their taxes. So very, very important to understand this. Investing in a business structured as limited partnerships is important if you really want to get that passive treatment. If an investor, for example, earns $100,000 in passive income from a successful business, but has $50,000 in passive losses from another business, they'll only be taxed on that $50,000 instead of the full 100. So we want to make sure that we are utilizing everything appropriately here. If you're going to do a business make sure that you're structuring it in the proper way so that we can take advantage of all the tax savings. The last thing I want to touch on here is the grouping of passive activities. So under the section 469-4, taxpayers can group multiple passive activities together to increase the likelihood of utilizing the passive losses. So this is especially useful when an investor has multiple business interests of varying income levels. They can group it together and kind of treat it as one activity. Now, this is something we use in real estate as well. Let's say we're doing a lot of real estate properties and we want to make sure that we're actively participating in there and count it towards material participation. Well, then we would group elect all of our properties, and then now it's active. All the losses from that can offset our W-2 income, and that's a strategy a lot of wealthy W-2 earners do. But in this case, we might want to do that for businesses, again, to qualify for either side. We always want to figure out, okay, what's great for your situation, what makes sense for you, and what do we want to lean towards, active or passive. Some last things to cover are passive activity loss limitations. So if passive losses exceed passive income, the excess loss cannot be offset with active income. It has to carry forward. So you got to keep that in mind. You have at-risk rules, right? Investors must be at risk for the amount of their investment to claim the passive losses. And you have the disposition requirement to fully deduct accumulated passive losses. Investors may need to dispose of their entire interest in a passive activity. So for passive business investors, the best tax deduction revolves around leveraging passive losses to offset passive income and leveraging active losses to offset active income in such a way where you are paying the least tax possible. So we help a lot of our investors over at TaxWise do this exact thing. So if you need help with this or have any additional questions, feel free to reach out. Our contact is in the description below. Thanks so much for watching and have a great day.